How much pain is too much pain to kill inflation? This is where we are in the US. This is where we are in the world economy. And this is what we're grappling with this week as we get critical data that may yet restart this decline in stocks since the beginning of the month and power further gains in the US dollar. Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at Tasty Live. And we are going to get the first big batch of economic news here for the week. So we are going to have a look and figure out precisely where this news is going to land us on the how much pain is too much pain continuum. What it's going to mean for stocks, currencies, commodities, rates, and for market disposition in general. So let's set the stage here. We are looking at August's Purchasing Manager Index numbers. If you are any kind of watcher of Macro Money, you know this is something we come back to constantly. These PMI numbers are a great, timely approximation of economic growth dynamics, more so useful for us as traders than usually GDP numbers, at least in terms of gauging where we are in the business cycle, because GDP numbers typically come out quarterly, and they are typically very lagged. So we are just now starting to see second quarter numbers firm up for the major economies, and needless to say, we are a month away from, a little bit more than a month away, give or take a month away, from the end of the third quarter. So those numbers obviously very much a look into the past. These Purchasing Manager Index numbers give us a better sense of how the business cycle is doing now, or close to now. And this is what we're going to see this week, the first batch of August Purchasing Manager Index surveys. So first, let's consider what the trend has been. Let's see what the expectations are. Let's see what all of this means for actually trading markets. So here is the trend. You can see here the slowdown began May of 2021. That's not surprising at all. We, of course, had a kind of cresting in the post-COVID catch-up right around then. The sort of lingering effects of stimulus where it was big and generous, like the U.S. and Western Europe, it started to fade. That catch-up started to come undone. And of course, this is also where worries about inflation really take center stage. Middle of that year, so just a month after growth crests, that's where you get the Fed making its seminal June 2021 announcement, where the Fed says, so it looks like inflation is going to be stickier than we thought, not as transitory as we hoped. We're going to have a meaningful tightening cycle, and yields start to go up. That's before the Fed ever issues its first rate hike in March of the following year. But of course, markets are forward-looking. The Fed is offering guidance. And so we begin to have a slowdown. Right around the beginning of this year, that slowdown has a bit of divergence to it. We can see manufacturing stays in contraction territory. When a PMI number is under 50, that's contraction. Over 50 is expansion. The further you go below 50, the faster the contraction. The further you go above 50, the faster the expansion. So what do we see here? At the beginning of this year, we get a bump in services. Most economies are driven by services. The service sector is about 70% of growth in most major economies. It's a little bit less in more emerging economies, but nevertheless, typically a bigger chunk than manufacturing, and in very early stage development economies, maybe manufacturing is a little bit bigger. Maybe it's about half and half. But for most economies that are formative for global growth, services is a much bigger chunk. And so you can see here that as services starts to diverge from manufacturing at the beginning of this year, global growth gets a pop. That makes sense. Much of the spending that we saw during the pandemic was focused on goods. That speaks directly to what manufacturing does. It delivers goods. As we get to the beginning of this year, there seems to be a bit more of a post-COVID dividend left in spending on things like travel, things like restaurants, things like live entertainment, in-person entertainment. Those things which were held back first by health ordinances during the COVID period, obviously, and then sort of post-COVID lingering anxieties, those anxieties with more broad reopening, more normalization, higher vaccination rates, all of that seems to start to fade away in earnest as we begin this year. And so you get a further pop on the service side. Now, with that, you get a bit of a pop in overall global growth, that composite index, because services is such a dominant part of the overall whole. That improvement now seems to have crested. You can see here, it appears to have reached a peak in May and has since started to slow down as the cumulative impact of tightening, of inflation, of those savings that were there because people weren't spending on these things during the pandemic, and so accumulating savings, those seem to have been spent down or more so depleted. And so we're starting to see services catch up on the downside to where manufacturing is. Manufacturing, you can see, has been below 50 basically since September of last year, and so in contraction. We find ourselves then in a global slowdown that is now anywhere between 2 to 3 months old. This is not unique to one group of economies or another. You can see this is what you're seeing in developed economies, certainly. Very much the picture of the global story. Manufacturing in contraction, services after a divergent bump higher, starting to roll over and catch up on the downside. It is what we're seeing in emerging markets. Same exact story. What are we going to see this week? Here are the expectations for the August numbers. You can see here that in the Eurozone, the US, the UK, that's where we have expectations. We're going to get numbers out of Australia and Japan as well. In all of these cases, whether we have baseline forecasts or we don't, growth has slowed since mid-year. In all of these cases. In the case of Australia, we're watching an economy that's shrinking across all of these measures. You can see the prior composite number was 48.2. Services doing a little bit better than, or manufacturing rather, doing a little bit better than services, but in no part of this economy are we actually expanding. In Japan, a little bit of a positive growth number, but manufacturing is in contraction, and the growth numbers have been slowing in recent months. Again, since mid-year. Where we have expectations, the Eurozone, the UK, and the US, we're looking at a situation where the best case scenario is manufacturing isn't going to contract any faster, looking at expectations. Everywhere else, we're looking at a situation where things are expected to get worse. Service is expected to grow slower. Economy is expected to grow slower or contract faster. in the case of the Eurozone. Now, the UK economy is, of course, very important, but it's not the biggest part of the global pie. Standalone, obviously, we know that the situation in China is dire, and those are not numbers that we're going to get this week. So what we're going to focus on here is the US and the Eurozone. This is, as we can see collectively here, something like 40% of global growth if we just take them at face value. If we consider that also a ton of what exists in that rest of world, 43%, amounts to vendors to that demand, and by the way, so is China a vendor to that demand, because you guessed it, China's biggest export markets are the Eurozone and the US, then their impact is much greater than just that 40%. So how these two PMI reports go this week should be a very telltale sign for where global growth is heading. Let's consider the expectations. Here's what the Eurozone looks like. So still in contraction, second consecutive month under 50 for the composite index. So getting closer to confirming that the Eurozone is in recession. Germany's economy, which is the region's largest, already shrank. We already saw those GDP numbers for the second quarter. That we're starting to see a second consecutive month of region-wide contraction here, so sub-50 readings. That bodes ill. That suggests that the slowdown we're seeing in Germany is spreading to the region as a whole, and that we're probably going to confirm that the Eurozone, if not already in recession, then is very much at the doorstep of one. What's interesting here is that economic expectations getting pulled down for next year seems to be giving data flow out of the Eurozone a bit of an opportunity to correct higher. This is the Citi Eurozone Economic Surprise Index. It goes up when data outperforms expectations. It goes down when it underperforms expectations. This is not something, by the way, that says anything about the data being good or bad. If the data is bad, but less bad than expected, the index goes up. Notice also that it's still below zero. That zero line is the overall flow of economic data tending to outperform or underperform. So what we've seen here recently is growth expectations for the Eurozone have been pulled down, and so data outcomes have had a bit of an easier time to perform relative to forecasts. They still are below zero, so they tend to underperform on the whole, but by a lesser margin. What this means is that we might get soggy PMI numbers, but they may not be quite as bad as expectations have them. So if we look at this, then maybe instead of a 50.5 on services, we get a 50.8 or some such thing. Maybe instead of 48.5 on the composite index, we get 49 or 49.2, something like this. Maybe instead of 42.7 on manufacturing, we get 44. Now, that would be better, but it wouldn't be good, and it wouldn't necessarily suggest that any kind of a recession has been sidestepped here. But it does offer the possibility that these numbers might register a tad better than expected. Let's hold that thought. Over on the U.S. side, here are the expectations. No meaningful changes here, no dramatic deterioration. Still slow growth, but growth at the composite number, 51.5. That's a bit of a climb down, but not a dramatic one. Services, a little bit softer on the expectations, but again, nothing dramatic, no big deviations from where we are at current levels. And manufacturing is seen shrinking again, but at a slightly slower rate. In the case of the US, economic data hasn't just been performing better than expected for at this point, give or take 6-7 months. That would be where you can see this holding above zero. But more recently, from about mid-year, data has actually increasingly outperformed by a widening margin. So quite a bit of resilience here in the U.S. economy, and perhaps scope for that data to perform better than expected. Perhaps slightly stronger growth. Maybe the manufacturing sector comes back to 50. That wouldn't be growth, but at least it wouldn't be contraction. Maybe so the service sector looks a little bit better. We just saw retail sales numbers that crushed expectations. So perhaps there's a bit more consumer optimism still left in these numbers for August. And maybe that gives a lift on the composite side. Now, on the one hand, this might be good for the global business cycle. This might, at first blush, seem like it could be good news for stocks, could be good news for growth, but not so fast. Because against this backdrop, what we see is the very same central banks overseeing these economies are starting to see their fight against inflation stall. Here we are not looking at any one specific economy, but we're looking at the picture as a whole. And so much as we're trying to figure out where global growth is going, it seems to make sense to look at global indicators here. So what we're seeing with the red line here is an average of developed market 10-year break-even rates. Break-even rates are bond market implied inflation expectations. So this is not some economist that's coming up with a model that's pulling out inflation expectations out of it. This is what global bond markets across major economies, not even just in the US, actually price in. In this case, we've taken an average of the US, the UK, Germany, Japan, and Australia, because, of course, these are the PMI numbers that we're going to have come out. So we're going to look at the overall sweep here. Well, what do we see? These tend to lead global CPI, global inflation, which has, as we can see here, averaged between 2 and 4% before the pandemic. You can see that right here. Right, this would be normal, give or take, for global inflation. And we are somewhere in the vicinity of 6 now. We can see that the process going down seems to be stalling, much as it is in the US. We can see that these numbers lag these expectations by about 6 months. So once we pull this data 6 months back, it seems to broadly line up with the market's outlook. And of course, that makes sense. Markets are forward-looking. So you are going to have market expectations, especially at the 10-year sort of tenor where you have the most liquidity usually, looking quite a bit ahead of realized results. And of course, it also takes time to put the data together. This is a world CPI, so you have to wait for all of the input statistical agencies to publish their numbers. Then you can make this one. And so there's meaningful lags here, of course. So what you're seeing then should be worrying, because it suggests that inflation expectations haven't continued to fall. And to the extent that that's anticipating issues with continued disinflation at a broader sense, the rise that we see in inflation in July, the first one since inflation started to come off last year, thanks to central banks' combative efforts, That may be something that is the start of a larger concern. Disinflation may have stalled here. Central banks may be struggling to convince markets that they're doing enough to keep inflation expectations falling and thereby to signal to markets that progress back to normal levels, again, down from 6 to somewhere in the 2 to 4 range, that this is in the cards still, that they're still having success. Take against that the possibility that you get slightly stronger PMI numbers. Now, if the U.S. numbers are as good as recent surprise dynamics suggest, as we just saw, and if the Eurozone numbers are not good in absolute terms, but a bit better than expected, might this signal to markets that these central banks are not ready to let loose of the reins of monetary policy, that they are not in a position to offer meaningful stimulus? Well, here we are in a global growth economy that's slowing for a few months now under the weight of that very tightening. And the easing that we've seen from China, the problem area in the three big nodes for economic growth, right? As we can see here, these are the three main ones. China is looking at a global recovery that seems to have bypassed it. It's really struggling at this point to get any kind of footing on external or domestic demand after it reopened in December. And it has attempted easing to try to kickstart growth, but it's simply not worked. As of the last inflation numbers, China is actually facing deflation. Now, 1 month of data is just 1 month of data, but it was nevertheless a negative inflation rate in that data. So, if China can't create enough stimulus and enough activity to offset its own issues, well, it's probably not going to offset the issues everywhere else. And so we have then a situation where at the same time, the global economy is slowing, but inflation is stickier, and central banks may not be in a position to actually back away from the inflation fight, having essentially invested their credibility in winning it. So what happens if you get a slightly higher set of PMI numbers? Well, you cement the idea that central banks can't go anywhere, but at the same time, you reinforce the likelihood that they trigger this global recession, which, if the Eurozone is already effectively there or very close to there, and China can't get off the mat, well, then your last hope is a slowing U.S. economy with a combative Fed looking to do more and saying it is prepared to risk a recession to get done what it wants to get done on prices. What would then a readjustment look like here? Here are expectations for what's coming up next from the ECB. We can see here there's a peak of an 82% chance of a rate hike by the end of this year. So it looks like the markets are leaning toward at least one more 25 basis point increase. And from there, we start to flirt with a chance for easing once we get into the second half of next year. We can see the likelihood of a cut slightly north of 50% by the time we get into July. So you can see that these are, of course, cumulative numbers, and you can see here the probability of a cut, one cut, by July is 51%. The probability of one hike, ostensibly the one that we're starting to flirt with taking away, by the end of this year is 82%. And from there, it starts to fade. Looking at the Fed, we're up to about a 46, 47% chance of one more hike this year, so about 50-50. From there, cuts. The first one fully priced in by the time we get to June. The second one fully priced in by the time we get to September. And maybe a third one by the time we get to year end. So the expectation is we're going to come in from a 5.25 to 5.5 to a 4.25 to 4.5 range on the Fed funds rate. So if these PMI numbers flag for markets that these central banks can't loosen yet, well, then maybe this is where the adjustments occur. Maybe we get one more hike fully confirmed for the ECB. Maybe we get some of this easing expectation diluted and the possibility of another hike bumping up above 50 for this year. But is that good news? Well, doesn't seem like it. If the global economy is already slowing and is about to slow for a third consecutive month, then the prospect of tightening that is at least more lingering than expected, even if no more hikes come, if rates are seen holding in restrictive territory longer, well, that just makes a global recession that much more likely at a time where the global economy is already at a knife's edge. And that is probably not good news for stocks, probably not good news for cyclical and growth-sensitive assets like crude oil, copper, the Australian dollar, the Canadian dollar. And it's probably supportive for defensive assets, like bonds at the long end of the curve. Think ZB in the futures market. Probably supportive for gold and silver in that it would anticipate defensive momentum in prices. That probably diluted because it would also mean liquidation and a cashing out, which probably benefits the US dollar. The front end of the yield curve probably holds up because much of this would be contingent on rates being higher for longer at that sort of tenor. And so you probably get a flattening of the yield curve where, let's say, the 2-year rate holds up, the 10-year rate comes in. A telltale sign would be if the Japanese yen is likewise rising. It too, like gold, is sensitive to a flattening of the yield curve and lower rates at the longer end. So if these PMI numbers actually surprise higher, the temptation would be to say this is good for growth. But the actual price action response, because markets are forward-looking, might well be, well, this means recession risk is that much higher at the global level because the central bank response will be to delay rate cuts and then perhaps to have to cut harder down the road. So the response may well be a risk-off response, much as we've seen through last week, and in particular last Thursday and Friday around global financial markets. And that is Macro Money for today. We're here every day, Monday through Thursday, right after overtime, a show that I do with Chris Vecchio, head of Futures and Forex here at Tasty Live, where we look at what markets did after the Wall Street close and try to figure out what they might do next. I'm also on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, opining in the news and insights section of tastylive.com, and commenting on Twitter, yes, Twitter, at Ilya Spivak. Thanks very much for joining. See you tomorrow.